Senator Warren eyes Dick's what's next in athletic gear. Activist hedge funds, we demystify the money, and Dollar's Tree, General and Family. Uber goes all in on discount stores. For Thursday, August 28th, it's Brew Markets Daily, and I'm Anne Berry. More market details to come, but first, let's talk about ride-hailing. I feel like I've used every service personally that is out there over these past 12 months. Lyft in the United States, Uber absolutely everywhere, Bolt in France, Get in London, Careem in Dubai, the list goes on. And for Brew Markets, so here at work, I've been watching the pattern of public rideshare companies going global. Earlier this week, I got to meet the Lyft CEO to talk about that business buying Free Now to grow in Europe. There's also the promise of autonomous rides, so the technology here is booming. And the team here in studio, well, we were just saying that we've spotted Waymo self-driving cars lurking around New York. Uber has partnered with Waymo to offer driverless rides to app users in Austin and Atlanta, with more markets to come. And the biggest rideshare player in the United States is actually doing pretty well overall. Uber's share price up over 50% year to date. So that sets the stage. With all the glamorous growth options available to it, geographies, technology, why is Uber going back to basics, literally? Because today, the company announced a new partnership with US retailer Dollar Tree, letting Uber customers get everyday items from party supplies to cosmetics delivered to them from one of 9,000 Dollar Tree stores. Now, this comes just 3 weeks after Uber announced an almost identical partnership with Dollar General Corporation's 14,000 locations. And then in May, same again, this time with Family Dollar. So why would Uber, once the poster child for bougie black car luxury service in urban centres, partner with dollar stores? Well, Uber CEO Dara Khosrowshahi gave us a clue back in the Q1 results this spring. Let's hear what he had to say.
We're expanding into new markets, both geographically, but into less dense markets. And there's a whole portfolio of newer products that continue to grow faster than the core, so to speak, that have substantial runways ahead of them. In terms of frequency in the less dense areas, our less dense initiative really started with delivery.
Delivery, there it is. Self-driving options are going to take a while to drive Uber's real revenue streams, pun intended. Urban markets are maturing, getting more competitive thanks to Lyft and rideshare and DoorDash and delivery. So Uber is looking to grow into rural areas, and that's where the dollar stores are. Now, consumers are looking to shop more at value retailers. We've heard all about that this earnings season, so they make sense as distribution partners with Uber Eats. Dollar General's report out today highlights that shoppers across income levels are trading down. So both win. Uber needs the traffic, and the dollar stores need to grow sales and fight off Amazon, but don't want to dump money into expensive shop refits to do that. Well, the value retailers have had a good run so far this year. Dollar Tree and Dollar General stocks up around 50% year to date, but they have been ticking down this week on concerns about hits from tariffs. So lots to this partnership for both Uber and for the discount retail sector. Lots more to come from Uber Technologies. We're going to keep watching this one. But first, if you want to take a drive through investing, check out public.com. Brew Markets Daily is sponsored by Public, the investing platform for those who take it seriously. Before the show today, our producer John mentioned a feature he recently found on Public.
That's right. I've been digging into crypto lately, and I discovered that on Public, along with stocks, options, and bonds, you can also trade crypto. Lots of tools to build and manage your wealth. Public has access to over 40 cryptocurrencies, including Bitcoin, Ethereum, Dogecoin, and more.
And if you have questions about your investments, no problem, because Public has Alpha, an AI-powered research assistant that helps you find the answers you're looking for. Fund your account in minutes or less. Get started at public.com/brewmarkets. That's public.com/brewmarkets.
Paid for by Public Investing. Full disclosures and podcast description.
So this week, John, we got quarterly earnings reports from Foot Locker and Dick's Sporting Goods. Foot Locker shares dropped on weak results. We're going to come back to that, while Dick's actually beat expectations and raised full-year guidance, continuing a trend of doing pretty well, thanks to growth in both the number of customer purchases and the size of those tickets. But the news that the market was really waiting for finally arrived, and that was confirmation that the two sneaker retailers are allowed to join forces. Now, Dick's acquisition of Foot Locker was approved by both shareholders and by federal regulators. But that approval wasn't a foregone conclusion, and we're going to unpack why. First off, though, John, remind us of the background. Give us the detail on the deal.
Sure. Well, back in May, Dick's announced its intention to buy Foot Locker for $2.4 billion at $24 a share, and that represents a nearly 90% premium at Foot Locker's share price. Dick's expects to run Foot Locker as a standalone business unit, so keeping the Foot Locker brand.
Right.
Ending up with a combined company with over 850 Dick's locations in the United States and Foot Locker's 2,400 retail stores in 20 countries across North America, Europe, Asia, and Australia. And here's the punchline, Ann. The combined entity would reportedly control more than 15% of the U.S. sporting goods market. That's a lot of sneakers. And so, Ann, was the deal ever at risk of not being approved?
So I love nerding out on deals because it gives the chance to cover a ton of ground. And there's two kinds of approval embedded in this conversation that I have my eye on. So let's start with approval from the regulators. Now, when these kinds of mergers and acquisitions are proposed, the Federal Trade Commission, so that's the regulator, investigates market dynamics to suss out if the proposed deal will harm consumers. And I'm going to be really specific about what that means. If you go to the FTC website, they tell you that they're committed to preventing mergers and acquisitions that are, quote, likely to reduce competition and lead to higher prices. I've got the printout here. Lower quality goods or services or less innovation are risks that they're looking out for when this kind of consolidation happens. And when necessary, the FTC may take formal legal action to stop a merger or sometimes to put conditions around it so that it can go ahead if certain adjustments are made to the deal. So just to go back in time, I started my career out as a merger banker. I started out right out of college working on these kinds of deals. And so I've seen firsthand the amount of work that goes into companies when they're coming together, when they know they're going to be reviewed by the Federal Trade Commission. They do a ton of work defining what the market means because they want to prove that they're not going to end up dominating a big chunk of it, right? So if I were to be working on this deal on sporting goods, and I'm not, but if I were to be, I'd be trying to look at the market saying, should we define it as sporting goods sold only in physical stores? Do we count e-commerce? Do we count sales of athletic goods in sports clubs, for example? Trying to get the whole thing to be as big of a market as possible. And then how do you define sporting goods? Is it just sneakers? Is it golf equipment? Is it baseball and tennis gear? And then you're suddenly talking about a really big market and ultimately getting less share as a result.
And then part of this review process, earlier this month, Massachusetts Senator Elizabeth Warren sent a letter to the FTC urging the chair to closely scrutinize the acquisition of Foot Locker and to block the deal if it violates antitrust laws.
Right. So we actually got a hold of this letter, folks. I've got a printout right here in front of me. And she doesn't opine on whether this violates laws, right? That's very specific. But she does lay out an argument that she's concerned that there might be consequences of this deal that could impact families. And I'm going to read out a couple of the things that her letter says. She says, quote, the combination of Dick's Sporting Goods and Foot Locker would decrease competition in the retail athletic footwear markets, cut jobs, raise prices, and leave Americans to foot the bill. This is particularly concerning, she says, given that more than half of parents plan to sacrifice necessities such as groceries because of rising prices for back-to-school shopping, including sneakers. So she's really focused on what this deal means for the cost of living for families.
And Ann, this is the first time I've ever seen a letter like this. I'm sure they're common, but I haven't done this type of looking into it. And I was struck by how exhaustive the research is. I was reading through that letter. There's dozens of citations from Bloomberg News and the New York Times, census reports, all this data. Here's an example of a stat in there. From 2017 to 2022, 1 out of every 4 shoe stores across the United States closed. The result was a loss of more than 25,000 jobs. And so she even cites other deals that have been nixed after antitrust scrutiny, like Choice Hotels taking over Wyndham. That one didn't happen.
Right.
And the proposed merger of Kroger and Albertsons grocery chains also didn't happen.
Right. It's not a given that these deals get done, is the point. Regulators really can get into the mix and change a deal or even make sure it doesn't happen. Now, as Dick's announced the deal with Foot Locker, there was one other thing that caught our eye, and that was the fact that Nike apparently sells about a third of its products through just those 2 retailers alone. Now, one of the things that Senator Warren says in her letter, again, I've got it in front of me, she says, quote, the new giant, Dick's and Foot Locker together, would have significantly increased power to extract favorable conditions with manufacturers. this could mean that independent retailers are at a disadvantage when it comes to negotiating with suppliers. And again, the scale here when it comes to Nike in particular is one that the market took notice of. So back in May, interestingly, Nike turned around right when this deal was announced and said, we, Nike, are going to start selling our products on Amazon again. So it's even as though they felt there could be some risk here and they got in front of it by making sure they diversified their distribution channels. Well, here's where we've gotten to now. The review did happen. It went through the regulators, and Dick's confirmed today that, quote, all regulatory approvals has been received. The company anticipates the acquisition to close on September 8th, 2025.
And as a retail investor, what this says to me is when you see a big merger and acquisition, there's headlines, the share prices are moving. You have to remember that just because it's a proposed deal doesn't mean that it's a done deal.
That's right. Volatility equals risk. When you see volatility in share prices after deals are announced, it's the risk that it doesn't go through. One final thought, because you asked me which approvals I was looking at. The other bucket of approvals here, shareholder approvals. Not surprisingly, Foot Locker shareholders approved this deal. If you've been lucky enough, smart enough to be a Foot Locker shareholder, this acquisition delivers value to you of a 90% premium of where shares have been trading. So not surprisingly, Foot Locker shareholders voted to approve this because they don't have to deal with more weak earnings reports like the one that they just went through this week. Dick's shareholders, on the other hand, I'm not one. I don't own Dick's shares, but I got to tell you, share price down, not particularly surprising. They must be wondering why. Given the risk of absorbing a struggling Foot Locker, why that this seems to be a good deal, no matter what the synergies or opportunities could be. Lots going on in these deals. We'll keep breaking those down, but we're going to take a quick break. And when we come back, activist hedge funds are all over the news. But what are they? John, we have a question from the audience.
That's right. Charlie in San Antonio wrote in, Anne, I keep hearing about activist hedge fund investors, and I keep pretending I know what they are. Can you tell me what they are and why I should care?
Got it. So the fake it till you make it. We're gonna make this one real. But bottom line, an activist hedge fund is part investor, part agitator, and sometimes part corporate matchmaker because they push companies to do things differently with the hope of making the stock worth more. The way I look at this is activists add a little bit of spice, a little bit of drama to the market. So from a theatrical perspective, I always enjoy it when there is a little bit of activist activity that I can follow. So here's how it works in broad strokes. An activist fund will buy a big enough stake in a public company to get the CEO's attention and to get the board's attention. And then the activist pushes for changes that they believe will unlock more value for shareholders. That could mean by suggesting how to cut costs, selling or buying assets, shaking up the board of directors, sometimes even calling to replace the top executives at the company. Now, there are a couple of headlines involving exactly kind of this thing. Just this week alone, Cineplex, the movie theatre company, called on by activist Wynwood Management to sell its digital media business and to use the proceeds to buy back shares. Medtronic, the medical devices maker, just added some experienced healthcare board members and announced 2 new committees, one to focus on acquisitions and growth, one to drive operating improvements. And they mainly did this because the activist Elliott Management pushed for change. So even when you're a $118 billion market cap company like Medtronic, you are still susceptible to activists coming up and trying to tell you what to do. Now, these are just 2 examples. And here's why the activists got involved in the first place. Medtronic share price down 8% for the past 5 years, Cineplex down year to date. And in both cases, activist funds saying it just doesn't have to be that way. Now, these funds think that companies could be worth a lot more if managed differently. And because these funds actually own a chunk of the stock, they have the incentive and the influence to demand those changes. And the way they make those demands are the following. They call management directly, sometimes in private, but they often build their case publicly as well. They write letters to shareholders and they often publish them. They put them out into the open. They rally other big investors and sometimes they go directly to the media. Others, like Bill Ackman, a famous activist, also takes to social media platforms like X. So a well-known activist and those with strong reputations can shake things up, even if they own relatively small stakes, like under 5%. So for everyday investors, here's why these battles can matter other than just the entertainment value. A successful activist campaign can boost the stock price in the short term because the market wakes up to the possibility of positive change. But when it comes to the long term, activist funds can be a little bit controversial. Data out there is a little bit mixed. Some argue that they can push for actions that create short-term gain but actually hurt long-term growth. Again, data mixed, and we can unpack that in subsequent episodes. But I'm glad you asked. It's one of my favorite topics, actually.
Yeah, and if you have a question for Anne, do like Charlie did and send an email or voice memo to brewmarketsshow@morningbrew.com.
Well, it's 4 p.m. on the East Coast. The bell is ringing because the markets have closed and we don't have a ticker tape. So we're going to throw it over to our human ticker, our producer, John.
Well, the markets were all up today. The S&P 500 hit an all-time high, reaching 6,500 for the first time and finished up 0.33%. The Dow was up over 0.1%, and the Nasdaq up 0.5% on the day. Some market headlines: Nvidia ticked down slightly today despite a beat on earnings and revenue for the quarter, and despite issuing near-term guidance that topped estimates. That's even without key new sales into China, continuing a pattern of the chip king issuing blowout results and the market just wanting more. And finally, Tesla was down 1% today on the news that its European sales fell 40% year over year in July, while Chinese EV rival BYD European sales were up 225%.
Always amazing. I'm going to take the market reaction on Nvidia. Never ceases to amaze me. Any other company delivering those kinds of results would have had absolute rip in its share price, but we just keep expecting more, moving the goalpost for Nvidia. One thing that we're looking out for as we race to the end of this week and get towards our Labor Day weekend break, we do have a slew of macro data coming out, and tomorrow is going to be actually a pretty big Friday. We saw the US economy expanded 3.3% for the second quarter. The data came out today that growth was stronger than initially thought. So let's say that the Fed is watching that, puts them in a slightly tougher spot. Are they going to cut interest rate? The market certainly thinks so for September. But tomorrow, we do have the Fed's favorite inflation indicator coming out, core PCE. Going to see how hot that runs, because that may have an impact on that September rate cut that everyone's been hoping for since Jackson Hole last week. That's it, folks, for today's Brew Markets Daily.
Brew Markets Daily is hosted by Anne Berry and produced by John Crotteau, Tariq Abdellatif, and Emily Milliron. Our technical director is Uchenna Nwaogu, and the president of Morning Brew Inc. is Devin Emery. If you'd like to get in touch, send an email or voice memo to brewmarketsshow@morningbrew.com.
Wake up tomorrow with the Morning Brew newsletter and tune in to Neil and Toby on Morning Brew Daily. We'll see you back here tomorrow, folks. Same time, same place.